This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning. We are, as always, coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, morning.
Hey, good morning. Holding on to that 19,400 mark yesterday. And once again, it's a kind of like a repeat of what was happening yesterday, right? Fall in crude prices. All eyes will, of course, be on Jerome Powell's comments. So lots to track today.
Yeah, and then the festive season is picking up, right? Less traffic on the road. The kids are at home. They're lucky. What about us?
You think the traffic is less? I was just thinking about it. Towards the weekends, as the festive season picks up, the traffic is
No, I'm saying on weekdays though, Sonia.
On weekdays,
yeah. Schools are shut. You know, you have those couple of bottlenecks when you're coming to work that going to get stuck out here. Really none of that. So that's good.
Well, clear in the morning at least, right?
Yeah.
Things market-wise are going to be clearer, or are they going to be a little confusing? I would say it's a second rather than the first. And I'll tell you why. So let's just quickly begin with the big things that happened overnight. So, U.S. yields and oil, they continued to sell off. So that's point number one. Last night was a repetition of a lot of what was happening over the last few trading sessions. So there is everything happened in the same direction, but the intensity of it was lesser. And you'll see why. So yields fell for the sixth time in 7 days. Yields fell. The 10-year, for example, fell about 5 basis points to 4.1%. By the way, the entire curve, which is starting with a 2, 5, 10, 30, the entire yield curve is getting flatter, which means the difference between, where the 5-year is and the 30-year is, or the 10-year is and the 30-year is, the difference is shrinking. So it's getting a flatter kind of a yield curve. Lots of debate about what that could really mean. Because it should not be flatter, but that's what's happening right now. Oil prices, they sold off once again. As I said, repeat, but lower intent. The day before yesterday, we had a 4% fall. Last night, we had a 2% fall. And now we are below $80 a barrel. It's now kind of gone to the 200-day moving average. So a lot of technical stuff happening. But fundamentally also, for example, earlier this week, we had the IEA, which lowered their oil price forecasts for the year ahead. So there is some stuff happening there as well. But prices have come off very sharply. Almost, $20 or so, more or less, in the last 1 month. NASDAQ, well, that made it to its ninth straight day of gains. So again, repetition, but very marginal, right? Actually absolutely flat, or eked out a small gain. And the small cap index in the US, which is much more representative of the broader economy, the Russell 2000, that underperformed once again, and the underperformance there was about 1.17% or so. So that's the global backdrop. I would say it's an okay backdrop in the sense that, yields are lower and oil is lower, but it is also, you've got to wonder whether it is also sending you a bit of a risk-off kind of a signal. The pace of the fall, you want yields lower, you want oil lower. But the question which one is left wondering with is whether these are signals of, maybe sharply slower growth or something else. So, and that is not what you want. So we'll see. Coming just to the market here, and I want to start with not the Nifty, the Bank Nifty. The small cap index yesterday made a new all-time high, right? But if you look at the broader market volume, there was no real substantial expansion in market volumes, which to my mind, is not exactly a great thing. It's not a positive thing. You want the market to go up with volumes, which was not the case, at least in terms of incremental expansion in volumes. The Nifty itself, it ended slightly above the 20-day moving average, which actually is now at about 19,393. We ended at about 19,443. So we are above it, and that kind of becomes something you need to defend now on the way down. Next resistance is about the 19,500 level. These are retracement levels, basically, of the full fall from the all-time high to the lows that we saw the week before last. And post that, you get to around 19,700, 693 levels, which is the 61.8% retracement of the fall from the highs. And supports for the Nifty come in at about 19,300. I think it's possible, just possible, that you basically get a day, 2 days of cool-off. The market maybe tests this support, 19,300, maybe a little lower, and then it makes a bit of a push higher once again. We'll see. But it would not exactly be unhealthy. We've had a sharp move up very quickly from the lows. On the Nifty Bank, we are now above the 20-day moving average. We've kind of built on it. 43,520 is the 20-day. Next resistance levels are based on retracements against the 50 and the 61.8, which are 44,200 and 44,700. And supports for the Nifty Bank would come in at about 43,200 or so. So, I mean, that's again about 1%, a little over 1.25% or so away from where we left off yesterday. GIFT Nifty is indicating a higher start, and we'll pick up when we kind of get that start. 35 points higher at about 19,526. Sonia.
I really like the texture of the market. I'll tell you why. There are many reasons which are supporting the markets to move up from here. Of course, one of them is the festive season, right? There's a general festive cheer. But apart from that as well, if you map the last couple of days, you'll notice that the Nifty has been holding around that 19,400 mark. In fact, global markets have also consolidated after a very, very strong run-up that global markets have had. There is a positive bias across the board. Just look at the flows, right? Domestic institutions have been buying in the cash markets for the last many days. So yesterday as well, 524 crores of buying. But more importantly, the FI selling has dwindled. There was barely 85 crores of selling by the FIIs yesterday, and the number has been lower for the last many days. So that's always a good thing. The mid-caps outperformed yesterday, and that's another space that perhaps you'd want to look at. Just look at the way the mid-caps moved. A 1% rally yesterday, while the Nifty was hanging on to the 19,400 mark. So all in all, the cues are on the upside. The fall in crude continues, so that's positive for our own markets. Brent is at a 3-month low below $80 a barrel. And yesterday, you did see stocks like Asian Paints rise in trade on the back of the falling crude. So that's another pocket to look at. Investors will watch data from the US. There's the US jobless claims that comes out. There's remarks from the US Fed chairperson Jerome Powell that will be watched closely. But in our own markets, if you're looking out for any stocks, there are plenty to talk about. There's the pharma sector continues to report strong earnings. The latest is Lupin, where the numbers were better than what the street was expecting, and it was an over 30% growth that they saw in their US business. So that could be one of the stocks in focus. Tata Power, United Spirits, a couple of other names that have delivered good numbers this quarter, and Tata Power has been a big stock this year as well. And in terms of earnings to watch, there are lots from the auto space. There's M&M, there is Ashok Leyland today, there's Eicher Motors tomorrow. So we have our hands full. But all in all, I think, this is a market that's aching to move up, just waiting for some of these hurdles to get crossed.
Well, that's right, Sonia. And as long as, the 10-year yield as well as Brent crude prices, they are lower, they're well behaved, right? So that's good news, and that bodes well for the Indian equity markets as well. In terms of, how our markets have done, well, in November so far, actually, the US markets, they're up between 3 to 6%. And the Nifty is up only around 2%. So we'll have to see some bit of catch-up actually from here, because the US markets, it appears, they have done far better in comparison to what we're doing. We are participating in this global up move, basically. The bears, though, they are positioned to protect the 19,500 to 19,550 odd mark. Today's weekly expiry as well, so we'll see how that goes. What did the FIs do yesterday? Well, they added more shorts than longs. So now the short position goes to around 81%. Close to around 4 shorts is what they added for every 1 long position. On the option side, we have 2 strikes that are fairly active and have the highest open interest. 19,500 on the upside, 1.4 crore shares out there. And on the downside, the 19,300 put. Both those 2 strikes should come up for you on the screen. Both of them have open interest in excess of 1 crore shares out there. Now, on the 19,500 call itself, the premium has come down to around 20 rupees from around 40 rupees odd. So it has seen some bit of writing at those levels. Which brings us to the levels. Since we're seeing writing at the 19,500 call, yesterday as well, it was fairly active. It has the highest open interest as well. So the odds are 19,500, 19,550 are defended in the near term. And that's what the bears are positioned for. Though on the downside, 19,250 to 19,300, that was a bit of a resistance zone. Now that becomes a near-term support. And you plug in the technical levels, well, they perfectly fit in this range that we're talking about, 19,250 to 19,550. You have the 20, 50 and 100 DMA, all of them in that vicinity. For the Nifty Bank, yesterday it did give up a little bit. Maybe it was weekly expiry related factor. But those are the key levels you wanted to continue to trade above, the 20 and the 200 DMA. It crossed that, it's trading above that, but you don't want it to breach that level decisively. GIFT Nifty suggests a green start, that's a 30-40 point uptick. You'll want the Nifty to build on this because we open bang in that resistance zone.
All right, Nigel, we'll sort of pick up on that. And so that's a setup that you need to know from a 360-degree point of view. We'll get you some calls now. This is on the money markets coming in. The rupee, the Parul Mithil Sinha of Standard Chartered says that The USD INR continued to trade in a tight range last week. Impact of dollar volatility and lower oil prices was offset by probable USD buy-sell activity by PSU banks. She expects the USD INR pair to trade between 83.1 to 83.35 to the dollar next week, with focus on the US CPI as a key driver along with oil prices.
Okay, let's also try and get you some bond market views. Parul says the domestic rates have traded with a downward bias, tracking global rates post the FOMC and a decline in oil prices. She expects the 10-year bond yield to trade in a range of 7.2 to 7.3% next week, with a focus on India and the US CPI data. She also says their research team sees India's CPI at 4.85%.
Well, we have a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. There'll be a lot of stocks that'll be reacting, but we have selected these in our Top 10 segment. You have Pidilite Industries, Tata Power, Lupin, Biocon, we have Eris Life, United Spirits, PI Industries, Patanjali Foods, and Ramkrishna Forgings. All of them reacting to positive news flow. On the flip side, BHEL as well as Bata, they'll be reacting to negative news flow.
Okay, well, that's a lot of stock-specific action, which we will get to in just a bit. But Mikso Das is Asia equity strategist at JP Morgan. He's now joining us to take some questions. Mikso, great to have you with us here. Thanks very much for your time. Just talk to us a little bit about are there any signals in particular which this plunge in oil and the plunge in yields is sending our way? Or this is just a, overreaction to an earlier upward overreaction?
I think this move is a little bit tactical in that sense. And if you look at global price action, right, pretty much everything is being dominated by liquidity. And liquidity in global markets, again, has been dominated by what's happening in the treasury market, supply demand in that space. And you can see very clearly demarcated that when the July QRA happened, when the Treasury made its quarterly refunding announcement, that's when markets started to break down. Risk assets fell, bond yields surged and all of that because liquidity started to tighten. And the same thing happened at the October QRA when the Treasury tried to shift the balance a little bit more, and that eased liquidity conditions. And we've seen basically everything rally ever since then. And that goes on. The only thing that has not been rallying and that has helped equity markets in the sense that it brings down inflation expectations is the decline in oil prices, which you also mentioned. So you put all of these things together, and it's kind of a Goldilocks for equities and risk assets overall, where bond yields are declining. Keep in mind that we are still in a very inflation-driven cycle, which means that equities and bonds are positively correlated. So when bond yields decline, equities do well. Given the fact that positioning in the S&P, in the US equities in particular, by the end of October was extremely light and very, very short. So it's not surprising to see a bit of a short covering rally here, which has been helped by this liquidity injection and has been helped by the decline in inflation expectations because of dropping oil. That translates into Asia. And of course, the dollar has softened from its peaks a little bit. So all of that plays very well into the Indian market as well.
And the timing is just right, Mikso? Because we are in Diwali season, peak festive season, and you want to see the markets in a good mood as well. Do you think there's more to go in the rally in the Indian markets? And how are you positioned? What's your view on India in the context of most emerging markets globally?
Right. So I think there's a tactical aspect to it, which obviously is going to follow whatever happens in the U.S. market. So if the S&P has, or U.S. equities have further room to run from here, which does look like the case, then Indian markets will be supported by that. But even beyond that, the main case that we've been making to our clients is that India is a market that looks extremely attractive on a structural basis. So even when we do get periods of tactical pullbacks and uncertainty in the market, we kind of see those as opportunities to buy rather than opportunities to significantly trim exposure. Just to give you an example, we recently did some work on positioning for EM and Asia ex-Japan investors. And what we find is that India is a market where the breadth of holdings, so relative to benchmark, which has only about 120 stocks in India, investors in EM and Asia Japan funds hold almost 300 different stocks in the Indian market. And this just goes to show that the market is basically maturing from a liquidity perspective, from a breadth perspective, from a sell side and fundamental coverage perspective, investor participation, and all of this kind of forms a a virtuous spiral, which will take the market higher over a long period of time.
Hi, Mixo. Good morning. Good to hear your views. Mixo, what about the toss-up between India and China? Because structurally, India is looking good. But tactically, in the near term, do you see a case where China could outperform, say, for the next 6 to 12 months? Because India has its set of worries, right? We have a big election, state elections, central elections as well that are coming up. And valuation-wise, we're trading at a big premium. Your take?
That's right. So there is definitely, if you look at India versus China correlations, they have been falling over the years, really since 2013, 2014. We've seen this correlation decline in terms of price action, in terms of macro revisions, in terms of flows. All of these correlations between India and China have been negative. And you're absolutely right that in the near term, we do see a very credible case for a China equity bounce, which we think can last into January before we need to reassess that. And in that context, it will put some downward pressure on India. But if you look at our allocation at this point, it's actually overweight both China and India. And we mention it as China being a more tactical overweight, whereas India being a more structural overweight. The point you make about the elections, that's true as well, that we do get a lot of investor feedback worrying about the state election results that are coming up next month. But we did some work on this, and I'm sure you're well aware that the state election results historically have not been a very good predictor for national election results. And from our perspective, it's really the latter that we care about. So if we do see any sort of volatility around the state election results, which, when that happens, we would, again, rather be using that as an opportunity to get back into the market.
All right, Mixo, we've run out of time, not out of questions, but have a great Diwali and festive season. And thank you for joining us on CNBC TV18 and giving us your views.
My pleasure.
Right, let's take a quick break on that note. On the other side of the break, our entire team will be with us to give us a list of top 10 stocks. Stay tuned. Welcome back. Our research team is standing by with the list of top 10 stocks to watch out for. First up, Lupin, very strong set of and Ekta is here to give us the latest on that. Ekta, over to you.
Well, yes, definitely the numbers were better than expectations. So we had the revenue, which was up around 22% for Lupin, the EBITDA, which came versus expectations of around 776 odd crores, which resulted in a quarter high in terms of margins at around 18.2%. Profit also better than expectations at 489 odd crores. Reason for this is primarily because Spiriva generic, an inhaler that they had launched a couple of months ago in the US market. So they didn't even fully capture it in the whole of the quarter, but it was partially there in this quarter. But nonetheless, that resulted in the North American markets, which is around 38% of their sales, coming in at $213 million, which again was a multi-quarter high for them in terms of sales. And this compares to around $185 million that the street was anticipating and compares to $181 million in the previous quarter. So that is the big positive. India grew up around 7%. The street was anticipating around 8 to 9% in terms of sales. But the big kicker for Lupin has come in from the US markets, which has resulted in the margins as well as the revenue beating estimates hands down.
All right, Ekta, thanks very much for that. Well, Pidilite is going to be in focus this morning for a bunch of things, but interesting news flow there as well. Mangalam, hi, morning.
Good morning. Interesting news flow indeed. You know, if as far as the numbers are concerned for Pidilite, nothing really to worry. In fact, the revenues were a mild miss as against street expectations on value terms, but the company more than made up for that in the EBITDA as well as the net profit. EBITDA margins as well as net profit were all above street expectations, as you can see the numbers on your screen. Year on year as well, there was a jump of nearly 36% in the company's operating profit and the net profit too. The volumes, they grew by about 8% versus street expectations of 4 to 6%, and favorable raw material prices meant that the gross margins expanded by over 1,000 basis points as against street expectations of 750 to 800 basis points itself. The management also positive on rural demand as well as near-term demand, but here's where the interesting news piece comes. They've announced a foray into their lending business to support their ecosystem. In fact, they will acquire a company from the promoter entity at about 10 crore rupees, a company that holds an NBFC license. It's called Pargro Investments, and they expect to invest about 100 crores in this business in tranches over the next 2 years. Yes, this will grab a lot of headlines that Pidilite is looking at giving loans to its vendors. But, you know, if you just take a look at the absolute numbers, it's not too much. It's about 5% of their annual profits. They're going to do that over the next 2 years. And importantly, a lot of companies already finance their vendors. So this is just another way of going ahead and doing that. So this will be looked at more as an operational thing than, you know, something that the company would look to scale and become a full-blown NBFC.
Got it. All right, Mangalam, thanks a lot for that. Well, let's go back to Ekta. She's tracking a couple of more pharma companies. Ekta?
Well, yes, I'm looking at Biocon and Eris because they did announce a deal post-markets yesterday where Biocon will be divesting 2 non-core branded formulation India business units to Eris Life. So they will be divesting dermatology as well as nephrology, which is basically kidney-based drugs, the branded formulation businesses for both of these segments for 366 crores to Eris Life. So this business includes 20 mother brands of Biocon, with an FY23 revenue of 90 crores and the current revenue run rate of around 100 crores. The deal will be partly funded through debt financing for Eris Life. It is positive for Biocon because they will be getting 366 crores in Eris Life because they will now be entering nephrology with this particular acquisition. Remember, in the past also they've had multiple acquisitions such as neuropsychiatry, dermatology. They've entered these segments through acquisitions, and they will now be entering the nephrology segment. They will be strengthening their position in the dermatology segment with this acquisition. Remember, Eris gets 98% of their sales from India, so hence it is going to be building its franchise within this space, and this should probably help them. I expect both the stocks to be in the green.
Okay, thanks a lot, Ekta, for that. Well, Tata Power also reported a good set of numbers, decent top-line growth, margin expansion. Vivek is here to give us the latest on that. Vivek.
Well, good morning. You know, so many moving parts as far as Tata Power is concerned. But this time around, you know, while certain levers like, you know, the coal profitability that the company enjoyed till a couple of quarters ago, while that is missing, other aspects of the business has come in to save the day. Now, when you're talking about Tata Power, the numbers overall has been a beat as far as the consensus expectations were concerned. Number one, console PAT was aided by Mundra on the back of the fact that Section 11 extension as far as emergency usage of thermal power plants was concerned. This particular development actually aided the profitability, and it's set to continue till June of 2024. So that is one positive trigger. However, on the to offset this particular gain, the coal profits, especially from Indonesian mines, fell this particular quarter on the back of moderation as far as coal prices were concerned. So looking at the numbers themselves, revenues higher by 12.2% on a year-on-year basis, EBITDA strong, up 75% on a year-on-year basis, and margins quite strong at 19.6%. Profitability up 8.8%. The company sales, higher project execution, higher PLF, the plant load factor as far as Mundra was concerned, and higher sales and a strong turnaround as far as Odisha was concerned actually aided the operational performance of the company this time around.
Okay, all right. Thanks a lot for that, Vivek. And remember, you can catch the management of Tata Power at 9:30 a.m. on Bazaar later today. Well, let's hop across to Surbi. She's tracking United Spirits. Hi, Surbi. Morning.
Good morning. So United Spirits, the numbers were ahead of expectations. If you adjusted for the sale of the portfolio, popular portfolio, the revenues were up 13% on a year-on-year basis. The gross profit margin expanded nearly 300 basis points on a year-on-year basis, and sequentially also up 40 basis points. EBITDA is up 21% and margins are up nearly 120 basis points. Now this beat has come from the prestige and above segment, which is the premium end of the segment. There the volumes were up nearly 4% and the realization were up 13%. In the popular segment, the volumes were down 11%, but that was on expected lines, and the realizations were up 1%. Additionally, the company has approved an interim dividend of 4 rupees, and this is the first dividend in close to a decade that they've announced. So I'm going with a green for United Spirits.
Okay, green for United Spirits, high-spirited first thing in the morning. Well, Vivek is with us to talk about BHEL and how that one looked. Vivek, over to you.
Well, that's right. BHEL, the same story continues. The order book is quite strong. Order inflows continue to be quite robust. But what's actually marring the performance is the weak execution or operational weakness that the company is seeing. So revenue from operations down 1.5%. But what's really disappointed is the fact that, operational profit has come in at a significant loss figure this time around. Along with that, on the back of that, rather, the loss has come in this time around on the bottom line of over 230 crore rupees. However, to offset, all of the negative operational performance, have a look at the order inflow. Order inflow this time around at 17,900 crore, largely aided by the large NTPC Lara Super Thermal Critical Power project that BHEL has received in the quarter gone by. Along with that, the order book this time around is at 1.1 lakh crore, quite significant, almost 4.8 times, the trailing 12 months revenue. So weak operational performance offset by a strong order book.
Thanks a lot for that, Vivek. Well, Mangalam joins us yet again to tell us about Bata and Patanjali. How are those numbers, Mangalam?
Well, for Bata, it was weakness because on the top line, the company continues to disappoint for the third or fourth quarter in a row right now. 819 crores is what the company reported on the top line, as against street expectations of around 870 crores. Though the EBITDA was largely in line with expectations because of gross margin expansion, and the net profit was impacted as against street expectations largely because of a 40 crore exceptional expense towards voluntary retirement. But they continue to add new stores. This quarter, they've added around 30 odd stores, and their sneaker store business is doing extremely well. Along with that, they have a manufacturing tie-up with Nine West and the athleisure business. So those are a couple of triggers that we'll be watching out for. As far as Patanjali Foods is concerned, yes, the revenues declined by about 8%, but I'm going with a green for that one, largely because these companies have now exhausted their high-cost inventory. The losses in their oil business are coming down, and as a result of which, despite an 8% decline in their revenues, the EBITDA doubled, and the net profit also jumped from 112 crores to close to around 254 crores. So, see green for Patanjali and red for Bata.
All right, Mangalam, thanks very much for that. PI Industries reported a good set. Sonal has got details here. Sonal.
A good set yet again, and PI Industries has been outperforming the industry. A strong quarter again, and it was a beat on all parameters. So revenues came in at 2,100 crore rupees, largely in line, but it was really the margins where the beat came. So EBITDA at 550 crore rupees versus a poll of 520 crore rupees. Margins at 26% versus a poll of 24%, leading to a beat on profits as well, which came in at 480 crore rupees. Even on a YY basis, if you look at the reported numbers, revenues, they're up 20%. EBITDA is up around 170 basis points, leading to a profit growth of 44%. It was led by the exports business, which continues to do well. They saw a growth of around 22% in exports business, but the domestic business continues to see some pressure. That's where they saw a reduction of 2% on a YY basis in their revenues. Pharma was 6% of their total export revenues. The EBIT loss continues, but that is something that the management expected. Expect a green tick on the stock today.
Okay, a green tick on the stock today. Thanks a lot for that. So lots of good numbers actually. Tata Power, United Spirits, PI Industries, Lupin. But let's also talk about something other than earnings. RK Forgings is on our radar. Vivek has the latest on that. Vivek, over to you.
Well, that's right. So RK Forgings, yesterday has intimated the exchanges that it's going to launch a QIP to raise funds. Now, the SEBI floor price for this particular fundraise works around 644 rupees a share. However, according to our sources, who had access to the term sheet, what we understand is that the company is looking to raise up to almost 1,000 crore via this particular fundraise. The indicative issue price is at 11% discount to yesterday's closing. 614 rupees a share is where the issue price is likely to be at. So this implies an equity dilution of 9.9%, almost a 10% equity dilution for fundraise. And we understand that the company will utilize the proceeds of this particular fundraise. There's a twofold purpose. Number one is for debt reduction, and number two for working capital expenditure.
All right, thanks a lot for that. Well, here's a quick recap in case you missed out on any of the stocks with positive news flow. There's Pidilite Industries, Tata Power, Lupin, Biocon, Eris Life, United Spirits, PI Industries, Patanjali Foods and Ramkrishna Forgings, while stocks with negative news flow, there's BHEL and Bata. But there were a long list of other earnings as well. So Surbhi is here. She's put that together for us. Surbhi, what's your list looking like?
So I have quite a few on my list today. Let me start with Phoenix Mills. It was a good set of numbers. Revenue up 34%, EBITDA up 35%. Margins have expanded by 100 basis points and PAT is up 40% on a year-on-year basis. Brigade Enterprises, they have good residential update. Also, the improvement in commercial sales is quite good. For residential sales, the net sales at 1233 crores versus 992 crores in the previous quarter. The net volumes at 1.6 million square feet. For commercials, the volumes have tripled sequentially at 21,000 square feet and sales at 16 crores versus 4 crores in the previous quarter. Masgao Dock, again a good set of numbers. Revenues up 7%, EBITDA up 50%, margin expansion of nearly 300 basis points. MedPlus Health, revenue up 26%, EBITDA at 85 crores, margins at 6% versus 5.3% same time last year, and profits at 15 crores. MCX, sequentially, it's a good performance, revenue up 13%, EBITDA loss of 17 crores versus a profit of 11 crores, but the loss is due to a contribution in the settlement guarantee fund and also software expenses, which were up 48%, but that was on expected lines. Net loss of 19 crores versus a profit of 19 crores in the previous quarter.
Thanks a lot for that list, Surbhi. Well, let's turn our attention then from the equity markets to the commodity markets. Manisha Gupta joins us as always to help us out on that front. Hi, Manisha. Good morning.
Morning, Nigel. Thank you for that. I'm keeping an eye on the crude oil prices, where we've seen a 6% decline in this week after 6% of a decline in the previous week as well. We are trading below $80 a barrel right now, and the prices almost hit $78 in the New York session yesterday. So the pressure has just about continued on the back of demand concerns from China and U.S. There are reports suggesting that the U.S. gasoline demand could hit a 20-year lows per capita in 2024, and the U.S. inventories at a multi-month high doesn't also help the cause. Apart from that, the street is also looking at weak Chinese data, weak European demand as well, and that continues to weigh onto the market. Much of the geopolitical or the war premium also seems to have gone away from the prices, and the street is now talking about $78 or even $75 a barrel of a possibility coming in for the crude oil prices within this month.
Okay, thanks a lot for that. So Brent crude well below $80 a barrel. Let's slip into a quick break. On the other side of the break, Dipan Mehta, Director at Elixir Equities, will discuss some fundamental stocks. We'll also be joined by Ramani Dati, who's the CFO at TeamLease, to discuss the company's Q2 performance. Stay tuned.
Welcome back. Hope you're having a good morning. Well, we told you all the stocks you need to track and how market is set up as well. Let's get into some fundamental analysis. Though Deepan Mehta, Director at Alexa Equities, joins us on the show. Hi, Deepan. Good morning. Hope you're feeling good this morning, Deepan. Well, we've got a lot of earnings that came in overnight, and some of them looked quite good. Give us your take on a couple of those names. Lupin's numbers, Tata Power's numbers, both of them look quite good. Have you had a look? Do you like any of them?
Yeah, good morning, Nigel, and thank you for having me on your shows. Yes, I'm all smiles, and the reason for that is PI Industries. First, the disclosure we and our clients are invested in it, and superb set of numbers given the context and the environment within the industry. At a time when peer group like UPL, Rallies India, and a lot of other agrochemical companies have shown very disappointing performance. Here's one company, which continues to grow from strength to strength. And even at that high level of base, as far as their agrochem export business is concerned, to achieve these kind of numbers is quite phenomenal. Completely justifies the high valuation that the company is trading at. And I expect the stock to do even better on today as well as the next 2-3 quarters or so. So I think that's the pick of the results. So from our perspective, what we have seen so far.
Which one are you talking about? PI, right?
Yes, PI Industries.
Okay,
yes.
PI Industries. Okay. So that's the pick of the pack for you from the result season so far. But as Nigel was saying, so many other numbers were really good. So there was Tata Power, there was a Lupin. And on Lupin specifically, I mean, it's been a 35% growth that they've seen in their US business. And we've had a lot of pharma companies this quarter that have done well, whether it's something like an Alchem, and before that, a couple of smaller guys as well. Anything in that space that you still like?
Yeah, Sonia, I think, we had the early signs of a turnaround in the pharma last couple of quarters, and this quarter really, they have pharma companies across the border performed really well. Particularly impressed by Alchem's numbers, and I'll tell you why, because we are focusing on companies which are strong in the domestic market, which derive high proportion of the revenues from the domestic market on account of their brands, distribution network, and feet on the ground. And Alchem's numbers, I think, were very impressive from that point of view. See, with Lupin and Dr. Reddy and Cipla and some of the other export-oriented pharma companies, you can always expect some amount of volatility in earnings because US generic market or global, there could be pressure on prices over there in global markets. But when a company is focusing on the domestic market, it is more like a FMCG business with high degree of consistency and secular growth. So I thought Alchem numbers were very good. At the same time, I thought Mankind numbers, I think, not as in terms of percentage change, not as much as some of the other pharma companies, but nonetheless, I think they're following up on the street expectations, and that company and business also is scaling up pretty well.
Deepan, hi, good morning. Just a couple of names, and these are on the back of big moves we've seen. The entire oil marketing, if you have any thoughts, pack. IOC is up 10, I think HP is up some 15% this week so far after yesterday's move. Prince Pipes had a very large move, second highest volumes ever on that one yesterday. And then, RR Kabil, again, a big mover from yesterday. Go on.
Yeah, I think oil marketing companies, the up move is completely justified because their marketing margins certainly will shoot up at this point of time because of lower crude oil prices. But you can expect government, kind of going into election season, you may expect these companies to have a slight decline in the petrol and diesel prices as well, and that may impact the margins negatively. But by and large, I think there is really nothing exciting as far as oil marketing companies are concerned. They are great trading bets, but not good long-term investment stories. Some of the other companies like RR Cable and Prince Pipes, which you mentioned, I think clearly they're benefiting from the boom taking place in infrastructure spends, and also they're benefiting from lower raw material prices. I particularly like the numbers coming through from all the pipe manufacturing companies, Astral, Supreme Industries, and Prince Pipe as well. Even Finolex, for that matter, came with good set of numbers. And these are companies which are growing at 15-20%. And even the outlook for the next 3 years is quite impressive.
Okay. I don't know if you track TeamLease or not, but we have the management joining us. So if you want to listen into that and then give us your view later, we'll come back to you in a bit, Dipan. The numbers were quite good, actually. The revenues went up by 16%. Margins saw some improvement sequentially. To discuss this and more, we have Ramani Dati, who is the CFO at TeamLease Services, who joins us now. Ramani, thanks a lot for joining us on the show. It was a good quarter this time for you. Just the overall business, I mean, 16% growth is what you saw year on year. The margins have now started to inch towards that 1.4% level. So want to understand first on margins, have the margins bottomed out? Because you had guided for steady improvement in margins Q2 onwards. Can Q3 and Q4 be better than what you've delivered? And give us an outlook on the operational performance.
That's right, Sonia. So as I have mentioned in the last quarter, our margins have already bottomed out because be it in terms of degree apprenticeship or the IT staffing impact, that's been fully absorbed. So there will be a steady improvement in margins as well as absolute profits on a sequential basis. And once the IT staffing comes back on track, that can be a wind on our back.
So you're also running a cost optimization program. Can you quantify for us what has the cost efficiency been up until now through that program, and how much of it you can you can see in the second half of the year as well?
Yeah. So we have mentioned in Q4 of last year that we will hold the costs, the core costs, at least for 6 to 7 quarters. We will not increase any costs in the back end. So we are on track with that. In fact, we have managed to bring down the cost run rate as well on a quarterly basis. We have already brought it down by about 50 lakhs compared to Q4 of last year. The cost run rate has come down by 50 lakhs a quarter. And we are targeting incremental another 50 odd lakhs by end of this year as a quarterly run rate. So that would kind of straight away contribute to our profits and margin expansion. And this is not by, choking the existing resources, Sonia. So this is more of process optimization and technology, digital engagement with those initiatives.
Okay. All right. Hi, Ramani. Good morning and good to see you in as always. Now, putting that cost, optimization strategy that you'll have in place, could you guide us for the margin band for the second half of the year? Point number one. And in our earlier chats, I think we were talking about revenue growth in excess of 20. I think mid 20% is what we were talking about. First half of the year, you have done mid-teens, 16, 17%, I think so. For the year, what kind of a number are you looking at? So revenues as well as margins.
Yeah. No, revenues in general staffing business, we are already close to 20%. And even by end of the year, at company level, we'll be hitting that 20% revenue growth. So what has impacted in H1 being sub 20% is mainly the specialized staffing business and degree apprenticeship business, because both of them are facing headwinds. However, by end of this year, we are confident that we'll kind of clock the 20% growth. And even into the future quarters as well, we'll maintain upwards of 20% of revenue growth. On margins, on margins, there is no precise guidance as such, because on top line, especially in general staffing business, we don't control the salaries of the contract employees. On absolute profits, there'll be a sequential improvement of 5 to 6% quarter on quarter going forward.
Ma'am, hi, good morning. What's the... so global captives are booming, right? We've spoken about this in the past as well. Isn't that able to offset some of the weakness in traditional IT services? And is there a slowdown there as well? Could you tell us? Hiring, and if you can put a number to it, what are hiring requirements down by, say, compared to where we were same period last year?
Yeah. No, you are right on that point, Prashant. So GCCs and captives are hiring. In fact, they are the ones kind of helping us to maintain the current base in our IT staffing business. Otherwise, IT services consistently for last 4 or 5 quarters, they have been kind of dropping even the replacement headcount. And we have seen almost a 20% headcount drop in our IT services customers in terms of headcount, which got compensated with the headcount growth in GCCs and captives. So that trend will continue, and but whether it can compensate and contribute to incremental growth at a substantial level, I don't think so in the next 2 or 3 quarters. As of now, we are confident of maintaining the base in specialized staffing business. And maybe down the line 2 or 3 quarters, once the momentum in GCCs also kind of accelerates, we can get back to at least a double-digit growth number.
Okay. So the total headcount, I just wanted to understand in terms of numbers, what are you looking at? In Q2, it was about 3 lakhs, a growth of almost 5% quarter on quarter. What are we looking at in the second half?
We should maintain a similar growth, only like 5 to 6% in Q2. Yes.
5 to 6% quarter on quarter growth in Q3 and Q4, is it?
Yes, yes, that's right.
Okay. Okay, got it. That's on total headcount. And in specialized staffing, I mean, you spoke about it, but you've also said that for the full year, specialized staffing will be absolutely flat. What are we looking at in FY24? Is there a growth that one can expect in in FY25? Is there a growth that one can expect in specialized staffing?
There is total uncertainty. As of now, there is no visibility at all, like how the IT industry will turn around. At this point in time, we are only targeting maintaining the base of 8,000 headcount that we have in IT staff.
All right. Very quickly, the cash in your books, could you quantify it? And what are the plans out there? Any inorganic growth you're looking at?
Yeah, we have a little over 300 crore of cash in our books, out of which close to 250 crore is free cash, which we can utilize for any organic or inorganic investments. At this point in time, there are no active discussions, no advanced discussions for inorganic aspect. But yes, there are multiple discussions, especially on HR tech space, where we can use those for cross-selling and upselling, but very initial stages of discussion.
Well, it's been good speaking to you. Thanks so much for stopping by and giving us all those details. Wishing you and your team a very happy Diwali as well in this festive season. For the time being, though, we'll look to slip into a short break. Up next, we'll get in Mitesh as well as Sudarshan. They'll be giving us their technical calls on the markets.
Okay, welcome back. There's about 9 minutes to go for the pre-open session. We have Mitesh and Sudarshan who are with us with what they'd like you to do in terms of trading idea, trading strategies. Gentlemen, good morning. Mitesh, continued gentle kind of upward move to your mind, or you think it's possible we see a day or two of pullback consolidation before anything else happens? What's the sense?
Morning, Prashant. So I think, we've closed right at the levels of 19,450, which I've been highlighting for the last 3-4 days. And I think getting past that would be important. Now, the gap up suggests that we'll just do that. So the idea is that if the gap doesn't get filled, which is about 35 points, then I think this could be an expansionary day and we could see strong up moves coming in. And the market should then head towards 19,600, 650 zone to begin with, and then maybe even higher levels. So the way I'll approach is that we'll add on to some long positions with the gap up today and keep stop just below 19,430. And if that works, and there's a good chance of that working out, then I think, we will look at a good market on the upside for the next 1 or 2 sessions.
Okay, got it. Thanks for that, Mitesh. Morning, Sudarshan. What about you? How are you approaching market today?
Yeah, good morning. My sense is that we are going to see choppy market action. I'm not talking specifically of today because today FNO expiry also comes in, so markets can do anything. But generally over the next few days, 19,400 is strong resistance. The markets should chop around that area before they decide to do something else. The overall short-term trend is up, so I'm also assuming that after this chopping around, whenever it finishes, the market will move higher. So the trade is really to be on the long side of the market, not immediately on sharp dips, and these sharp dips come every day.
What about individual stocks? What are we looking at this morning? Sudarshan, let me start with your list first.
Okay. Coal India is a buying opportunity. The stock has gone into a trading range after a handsome rally. That range should break on the upside. Buy with a stop under 310. Havels is my only intraday short. It had a distribution, broke down severely from that distribution and continues to move down. It's a short with a stop above 1270. It's intraday. Maruti is a very interesting chart. It's bouncing at support again. Now, this support can actually break. So no one can forecast that. But given the fact that it's been a strong performer recently, that support should hold. So we are buying on a dip already. Buy with a tight stop around 10,150. And finally, Reliance is a buy. Reliance is a buy. A V-shaped rally in Reliance suggests that perhaps more upside is coming. Buy with a stop under 2,300.
Okay, thanks a lot for that. Mitesh, what about you? What would your list look like?
Good morning, Sonia. I have all buy calls today. Cipla and the entire pharma space is buzzing nicely. We have had buys on Aurobindo, Glenmark, etc. Cipla is the stock which I have picked today. Keep a stop below 1220. Look for targets of 1275. Also a buy on Berger Paints with a stop at 572. Here I would look for short-term targets of 610 on the upside. And a buy on Chambal Fertilizers, which I would recommend buying on a point or two kind of a decline if you get it. Keep a stop loss below 294 half and a target of 308 can be looked at. And finally, Siemens after a good decline is showing signs of a bounce back. So that's a buy with a stop below 3,400 for targets of 3,495.
All right, gentlemen, good getting those trading ideas. Mitesh and Sudarshan, appreciated you guys joining in. Chandan Taparia is with us, derivative and technical analyst at Motilal Oswal Financial Services. Chandan, good morning. Good to have you here. What's your sense, Chandan? How is the setup on the FNO side looking, and what are your recommendations?
Good morning, Prashant. Thanks for having me. So we have seen a decent recovery in last 6-7 trading session. Nifty has been forming higher lows where supports are gradually shifting higher. The only concern is that it opens gap up and then remain consolidative. But the good part is even after that, the base of the market is shifting higher. India VIX is near 11 and has been moving in a broader range between 10 to 12.7. So volatility is in control. Put call ratio is hovering near 1. FI's long short ratio has recovered to 20% again. So all these data setup are indicating positive to range bound bias in the market. So we believe with support of 19,333, this ongoing bounce could continue to us 19,550 to 19,600 zone. Looking at the Bank Nifty index, we have also seen some recovery in the Bank Nifty. However, in the last month, we witnessed some built up of short, those covered. So 43,000 and 43,300 is going to be the broader support zone. And with this support, Bank Nifty can also witness some recovery towards 44,000. So positive to range bound bias is clearly visible in both the indices. But even after that, mid-cap, small-cap and selective sectors are comparatively doing well. So we need to focus closely with those names. Now talking about trading ideas, first is buy on TVS Motor. We have positive view on auto, consumption, gems and jewelry, looking at the trading as well as the festival theme. So TVS Motor we are recommending to buy as Nifty Auto Index is doing well. One of the strongest counter. Again, it is giving a fresh breakout and entering into the new lifetime high territory. We have seen better rollover, put writing is visible. Consolidation breakout with hold of moving average indicating up move. So recommending to buy on TVS Motor with support of 1615 and the stock can head towards 1700 level. Second trading area that is buy on McDowell, United Spirit, the high speed ahead of the festivity, making higher top, higher bottom. All set for the fresh leg of rally. So recommending to buy with support of 1080 and McDowell can head towards 1140. And last but not least, that is buy on Titan. We have positive on the gold, gems and jewelry stocks. And Titan is one of the strongest counter. After the consolidation of last 20-25 trading session, it is again giving the scope for 5 to 7% rally. So one can buy with support of 30 to 50. And Titan has all potential to rally to us 34.50 to cheer the festive season.
All right. Thanks a lot for that and have a great festive season. Have a great time today. Thanks for joining in. Let's take a quick break on that note. On the other side, we'll have the pre-opening rates. Also, Shrivar Kheruka, the MD and CEO at Borosil, will be joining in to discuss the company's performance for the quarter gone by. Stay tuned. Welcome back. This is Open Exchange live from the CNBC-TV18 Motilal Oswal studio. We're just heading into the pre-opening rates and my director alerts me that the pre-opening rates have kicked in. So let's take a quick look at some of the numbers that have been good this time around. There's Tata Power, very good set of numbers. PI Industries was quite strong. Lupin was a good set of numbers as well. So all of these stocks could perhaps be in the green. We have Dipan Mehta who's still sitting with us. Dipan, I wanted your thoughts on, a whole host of auto numbers that will be coming out over the next couple of days. There's M&M, there's Eicher Motors, there is Ashok Leyland, and these are companies that are expected to report good set of numbers. Anything that you would buy in advance?
No, Sonia, I think the auto story has been pretty well discovered and investors are well invested in these stocks as well. And the numbers, the good numbers are more or less, I think, priced in last 2-3 quarters. They've done exceptionally well. The only thing we'll be tracking over here is the increase in the average selling price and the operating profit margins and how much benefit they're getting from lower raw material prices. But other than that, I think the volume story is known to everyone. And this is one sector, I think, which is seeing a strong cyclical up move.
Dipan, we've had a few cement companies that have come out with their set of numbers as well. JK Cement, JK Lakshmi Cement, they surprised positively, while Birla Corp was more or less in line. That's not been a preferred sector for you. But any of these select companies are doing well. Would you give them a look?
No, it's not a preferred sector from medium to long-term perspective, but next 2-3 quarters will be exceptionally good for cement companies. They will benefit from strong volumes and lower input costs and lower freight costs as well, and which is reflected in the numbers that we have seen so far. I would go with ACC and Ambuja. I think change of management over there will certainly bring in more aggression. And these two companies are poised to increase market share at a rate faster than anybody else in the industry. And valuations also are pretty much reasonable. So from the cement perspective, I think we expect these two companies to be outperformers. Although there could be some corporate action in some of the smaller cement companies which could lead in spike in prices over there.
Yeah, no, absolutely. Any thought on these? I mean, we discussed BSC a few days back. Even from that elevated level, it's seen almost at 2100, I think, closer to 21 than to 2000. It's big moves there. Actually, the entire exchange space, right? MCX has been doing very well. Any thoughts here, Dipan?
Usual disclosure, I think we like MCX, and for two reasons. I think one, the technology cost is going to come down significantly, and secondly, the way NSE had the upsides in options trading, something similar is playing out on the MCX as well, where after seeing slight drop in volume because on the futures side, now the options volume are taking off pretty well. And what we're observing in the marketplace is that a lot of the options traders on the NSE are also now getting more and more active on MCX as well. So there's an opportunity for MCX to capture that trading volume, which stops at 334. Then it can shift to MCX, which has trading hours right up to 11:30 or so. So I think that MCX is a good story to track, and great operating leverages as all exchanges do have. So any increase in transaction revenues, transaction charges revenues, a lot of it will flow to the bottom line.
All right, Dipan, appreciate you joining in and giving us your view on all those stocks. Wishing you a good Thursday ahead. We look forward to chatting up with you rather soon. Well, for the time being, let's focus on Borosil Limited. They reported a rather good set of numbers, good revenue growth, the EBITDA growth as well. Profit after tax was impacted, though, by higher depreciation. To discuss the way ahead, we're joined by Shrivar Keruka, the MD and CEO at Borosil. Hi, Shrivar. Good morning. Thanks so much for joining in. Well, both your segments have grown quite well, the consumer segment as well as the scientific business, which is pretty good. Wanted to ask you a couple of aspects. How is Q3 shaping up, point number one? And what does it mean in terms of growth for the entire year?
Well, thanks for having me. As far as the consumer business is concerned, we've had, a pretty tough Diwali, actually. The year has been much more challenging than expected from a growth perspective. And we've really had to push very, very hard to achieve even these growth numbers. The Q3 is, say, in line with what we see in the first two quarters. So no major deviations. And I expect we will continue to grow, but maybe slightly slower than we had ourselves anticipated. There has been a lot of pressure, in the markets from on pricing, and also I would say in demand itself has been a little bit muted. So on the consumer side of the business, things are a little bit challenging, but we've added capacity, and we've also added new product categories, which have allowed us to, maintain that growth.
Shrivar, you're sounding a little bit cautious. So just wanted to get to the point in terms of revenue growth. Earlier, you were talking the consumer segment, you'll grow by close to 20%. And I think the scientific business, you'll grow by, on an average, close to around 15%. Do you maintain these numbers for this year? And what about the margin outlook in both these two segments?
Yeah, absolutely. We will certainly maintain these numbers. Actually, frankly, when we had added the capacity, we thought we would outperform this. But so 20%, from my point of view, was a little bit conservative in terms of guidance. But we will definitely maintain the guidance, but probably will not be able to outperform that guidance. On the so as a whole, it's a bit more challenging than expected. That's why I'm a bit cautious, frankly.
No, that's important. It's important that you put it on board, and it's very candid as well, right? I mean, to tell us that there is definitely a slowdown in consumption, and here's how it's looking on the ground. So you said that there's some pricing pressure that you're facing. Can you just elaborate on that? How much pressure is it currently compared to, say, what you've seen in the preceding 6 months? And what would this mean for your margins? Because the first half, you did about 14.5% margins. What kind of pressure do you see in the second half?
So in general, what happened after COVID was that we saw a lot of imports, unorganized imports, in my view, reduce. Because obviously there was not accessibility to China, or there was low accessibility to China. Moreover, freight costs were very high. So we saw that unorganized players were, a little bit muted. Now this year, we've seen somewhat of a reversal of that trend, where we do see a lot of imports coming in at very low prices. So in that sense, customers have a lot more lower price options to choose from. And therefore, we believe that's impacted, or that's had an impact on our ability to keep prices higher as we would like. On the flip side, the reason we have still been able to, drive margins improvement is that our costs have come down. And that's owing to two reasons. One is commodity prices themselves have come off. And second is that economies of scale. So we have had some operating leverage. So we've been able to maintain and grow margins. I don't see margins coming off. I see them improving. We've given a guidance that they should be in the high teens, in the next year or two, which we will maintain. But in principle, we always try to be a little bit, let's say, a little conservative in our guidance, and try and outperform that.
Shrivar, hi, good morning. So just to pick on that point, is it the fact that lower priced imports, right, glassware is available and that is hurting you, or is there actually just a down trading because consumption trends are weak, and we hear that from other businesses as well?
I don't think it's to do with glassware being available at low prices. I think it's general consumption trends being weak and optionality available in the market. So, for example, when people are going to, give a gift, they are not necessarily looking at glassware to gift. They're looking for a gift with a budget. When they have many more options available, then they switch to other products. And therein lies the challenge for us this year.
Interesting. Shrivar, final question before we let you go. By when do we see 2 listed entities?
Yeah, that's a good question. We've finally got an order from NCLT approving the merger scheme, which was much awaited. And I think by January sometime, we should see Borosil Scientific being listed as a separate entity coming out of Borosil Limited.
Oh, by January, you said, right?
That's right. That's
okay, all the best. Okay, all the best. Thanks a lot for that quick, analysis on the business. And you said that things are slow now, but hopefully things should recover over the next year or so. But let's get back to the markets. Looks like it's going to be a decent start. Sudarshan and Mitesh are back with us. Folks, what is the 9-10 call? Sudarshan, you go first.
Reliance is a buying opportunity with a stop under 2300.
And Mitesh, what about you?
I'll go with a buy on Cipla and look for targets of around 1275 here.
Thanks a lot, gentlemen. We'll touch base with you within the next 1 hour or so. But let's go back to our top stocks that we're tracking. Sonal joins us to tell us about PI Industries and GNFC. Sonal.
Thank you for that. For PI Industries, it was a strong set yet again. Company has beaten all the expectation when it comes to our CNBC-TV18 poll. Revenues have come in at 2,100 crore rupees. EBITDA at 551 versus a poll of 520. Margins at 26.1% versus a poll of 24.1%, leading to a profit growth coming in higher at 480 crore rupees. On a YOY basis, it's a revenue growth of 20%, EBITDA growth of 170 basis points, and profits are also up 44%. It was led by their export business, where the growth was 22%. Domestic revenues continued to see a decline, down 2% on a YOY basis. Pharmaceutical, the new vertical, is around 6% of total exports. And the company said that gross margins also improved to 47%. It was on the account of better product mix, and working capital has also reduced for the company to 84 days versus 111 days at a time when working capital has been stretched for the sector itself. On GNFC, it was a weak set for the company. Revenues down 20%, EBITDA was down to 170 crore rupees, which halved almost, and margins down 400 basis points, leading to a profit decline of 23.5%. Company says it was largely because of a planned shutdown that they had taken, resulting in lower volumes. And apart from shutdown-related impacts, the output prices, they have been coming off, and that is something that hurt revenues as well. But board has approved a buyback to the tune of 84,78,000 shares, which is priced at 770 rupees per share. Even though the buyback is more than the market price yesterday, it is a disappointment because the street was expecting a higher price. So so GNFC is in focus on the back of that.
Got it. Thanks a lot for that. United Spirits is the other one that's looking pretty good post numbers. Surabhi has the details. Surabhi, over to you.
So the numbers were above expectations. Revenues were up 13%. They've seen gross profit margin expansion on both year-on-year and sequential basis. And EBITDA margin is up nearly 120 basis points. Overall volumes were up 1%, but the premium segment, there the volumes were up nearly 4%, and that too on a high base. They've also declared a dividend. They've declared a dividend of 4 rupees, and this is the first time that they've declared a dividend in a decade. Macquarie has an underperformed rating with a target price of 780. They say the sales growth was above their expectations. There's continued strength in the regular volumes despite the sharp increase in the sharp tax increase in the Karnataka state. Sequential gross margins expansion is a positive, and payout of interim dividend is also a positive. Headwinds from input cost inflation has some concerns on the gross profit, and that is what they'll be watching out for in the conference call today.
Okay, thanks very much, Surabhi, for that. Let's just sort of put the spotlight on Lupin as well, which reported numbers. Ekta's got details here. Ekta.
Well, definitely a very good quarter which came in for Lupin. The revenue was up around 22%. The street was anticipating a 16% growth. Margins came in at a multi-quarter high at around 18.2% versus expectations of 16% and versus around 10.9% same time last year. Profit also better than expectations at around 489 odd crores. Now, in terms of the key reason for these good numbers was the North American business, which is around 38% of sales. And within that, it was the launch of their inhalation product, Spiriva Generic, which is a limited competition drug. So they made around $213 million totally from the US business, which compares to around $181 million in the previous quarter. and versus expectations of around $185 million. It was a multi-quarter high in terms of US sales as well. India was a little subpar, so around 34% of total sales. It grew around 7% versus expectations of around 8 to 9% in terms of growth. So overall, Street is likely to be optimistic considering that the company has already achieved 18%, which was an exit run rate in terms of margins, and over $200 million in terms of sales in the US, something that they had eventually guided for. So the scale up will be important. Remember, stock has run up quite significantly from its 52-week low. It's up around over 90-odd%. So maybe a little bit of the good news could also be factored in.
Okay, thanks a lot, Ekta, for that. Well, we're just heading into the market opening. About 10 seconds left for the opening today. Looks like it's going to be a good one. The Nifty is hanging on to 19,450, which is a good thing. And a lot of individual stocks are up and about. We've had some strong numbers from the likes of Lupin, Tata Power, PI Industries. So all of that could support the market today. There you have it, the first tick on the index. Nifty absolutely flat, just consolidating around 19,400. The Midcap index is having a better showing, so the broader markets are looking pretty good, up about 116 odd points for the Midcap index, and the advanced decline ratio is solid at 1,600 stocks on the advancing side. Let's take it straight to the gainers now. BPCL, Adani Ports, ONGC, Apollo Hospitals, your top 4 gainers. Dr. Reddy's has been gaining quite a bit of ground. In fact, this year, Dr. Reddy's is now up 30%. Apollo Hospitals, Divi's Labs. So Pharma is doing quite well this morning. Let's take a look at Lupin because that's the one that's delivered a good set of numbers. So Lupin should be up for you on your screen in a minute, 1.5% higher there post earnings. You have M&M coming out with earnings tomorrow, so up about 0.4% on M&M. Hero MotoCorp is looking pretty good as well. L&T, Asian Paints, and a couple of other stocks that are trending in the green right now. On the red side, you have Tata Consumers, Tech Mahindra, Axis Bank, Bharti Airtel, and HDFC Bank. So, in general, the consumption space is a bit under pressure. Britannia, HUL are in the red. Eicher Motors comes out with earnings tomorrow. That one is a tad bit in the red as well. So, you'd have to say, give and take everything, it's not a bad opening, flat, but at least holding on to the gains of yesterday.
Well, that's right, Sonia. We're getting mixed numbers actually in terms of result reactions. A few of these stocks that are getting a bit of a knock this morning should come up for you on the screen. MTAR Tech, that stock is down close to around 8%, so that's seeing a big sell-off out there. You have Ami Organics, that's down close to around 6%. It appears the street didn't like these numbers too much. JNFC is down close to around 4.5%. MTAR Tech is now down close to around 10%, so big cut being seen out there. Avalon Tech as well. Remember, these stocks have run up a good deal, but the numbers appear a little bit disappointing. So you have Avalon Tech as well that's under some pressure. HEG, well, the management had told us actually in the past quarter that the next quarter as well will be fairly muted. And the numbers were quite muted as well. So HEG has opened up with a cut of around 3%. And Sri Renuka Industries as well is lower. So those are about the stocks that are losing and most of them reacting to numbers. On the gaining end, you have Welspun Corp. Well, the numbers look quite good. There's a ramp up in terms of pipe volumes. Also, they got a good amount of order book and debt has come down. So Welspun Corp is up close to around 5%, I think, as we speak. GMR Path, it's one of the top volume movers today. So that as well is up close to around 5%. It's locked in upper circuit. Ashoka Bilcon is another name that's moving quite well. So those are quite a few stocks from the broader markets that are moving around, most of them reacting to numbers. But I think from the frontline F&O names, just trying to pull up a few stocks out there. GNFC, that's a loser. You have Oil India as well, that's under some pressure. While on the winning end, you have PFC. That stock is up a good 3%.
20 points lower. So, as we were saying in the morning, maybe it's not going to be a bad thing if you spend a day or two consolidating a little bit, maybe a little bit sideways possible. We'll see. 20 points lower is what we have on the Nifty. This is just the start. Take a look at what we have on, some more names. So Tata Power, and you'll hear from the management in just a bit from now. It's down 3%. So Q1 was soft, and Q2 is actually okay. But when compared to consensus expectations out there, it's a bit of a miss once again. United Spirits, McDowell, that's down about 1.7%, 1,081 on United Spirits. Tata Elxsi will come up, and these are the big volume-led losses. Price-wise, 1.5% cut, but there are volumes, 8,118. There is Oil India, which is down 3.5%, so that's a direct oil play. Oil prices go down as a production company. What they're able to get in terms of realization goes down as well. Cupid, which had a frenzied move recently higher, is down about 5.5%. HEG is down about 3.6% as well. And look at Mama Earth, which is Honasa. It basically, I think, started trading at about 330, and it's at about 310 right now. That is Honasa coming up with not large volumes, but it's got some right now. Devyani is another one which is down about 1% or so at this stage. And some gainers, apart from what you guys mentioned, PFC is up 3%, is the top volume traded gainer, by the way, across the board. There is Brigade, another management you will hear from in just a bit on the program here. Brigade is up 5.5%. So that's a strong gainer. Yesterday, Prestige was very, very strong. Nazara Tech is up about 2.6%. MedPlus is up about 4%. And yeah, I mean, there is a fair bit opening up. Market breadth is positive, although it's nothing, you know, gangbusters. It's 1,100 stocks higher and about 800 stocks which are lower right now. Sonia.
Guys, are you sure you're contributing enough to United Spirits earnings? Because the stock is under pressure. So, you know, it's a festive season. Come on, you need to kind of do your bit.
On the weekend. Try to contribute.
Sonia's message, start chugging. Anyway, well, you know, more on that later. But 30 points lower is what we have on the Nifty, 19,415 on the index. Gautam Trivedi is with us now. He's, of course, our market master of the day, co-founder and managing partner at Nepean Capital. Gautam, great to have you with us here. Thank you very much for your time. Good morning. I believe you've just returned from a trip to the US and you've had the opportunity to sort of sit down with many investors. What's the mood like? I mean, you know, positivity and optimism from what we read and what we hear and, you know, our interactions in terms of attitudes to India and investing opportunities here seems to be at a peak. I mean, pretty high, pretty good. Go on.
Yeah, Prashant, thanks for that. I think the fact is that on this specific visit, I met a cross-section of investors, including a few college endowments, institutional investors, family offices. I think the interest in India clearly is at an all-time high. I've never seen this before, and clearly at the expense of China. So that's the good news. Having said that, I think there's a bit of a wait and watch with respect to incrementally putting new money to work in India. And that's coming from the fact that we are still the most expensive market in the world. So there's no, you know, running away from that, unfortunately. And I think even though we've seen over $5 billion of selling by foreign portfolio investors in the past just over 2 months, in spite of that, I think I mean, a lot of that has been offset by domestic flows. So until the domestic flows don't slow down, I don't see a deep correction in this market. And that seems to be, I think, a bigger problem with respect to putting incrementally more money to work. So that's the first point, I think, which I came out with. The second, of course, was you know, with respect to the price of oil, and I discussed that with a lot of people. What I found from them, and this is interesting, that a lot of them believe that yes, the Middle East crisis and the war will be a prolonged one. Unfortunately, that's at least that's the view, the general view out there. But the price of oil may not necessarily go up incrementally too much from these levels. It may cross $100. I'm not saying that it won't happen. But the fact is that as oil keeps moving up, the view, at least in the US, is that renewables become even more economical. So given that effect on renewables, I think even the oil-producing countries are pretty smart, and they do understand that taking the price of oil up way too much above $110, $120 will end up hurting them in the longer term. So I think these are some of the issues that I came back with.
Okay. So what does all of this mean from an equity standpoint, Gautam? Thanks a lot for joining in, and
Sure.
season's greetings to you and your team.
Thank you.
This year has been very good for Indian equities, right? Do you think that we can build on to these gains in the next year as well?
Yeah, so we're up about 6.5% year to date in rupee terms. Dollar terms, of course, it's not that great. But if I look at the overall emerging market pack, and I think that's something which we are part of, if I take out China, which really, I mean, there's complete lack of interest in putting incrementally any new money to work in China, in spite of the valuations. I mean, MSCI China, for example, is at 9.3 times, calendar 24 PE. We're at 20 times. So we're at 115% premium to China. And in spite of that, the lack of interest remains in China. So I think, like I said, I think the incremental flows from FPI investors will be muted into early next year until we don't see a significant correction in our markets. We did have a 5.5% or so correction from the peak in the month of September, but then again, we've seen about a 3% rebound. So I think that clearly remains a concern for foreign investors. And I think, the fact is, domestic investors have a lot of faith in their own country, which is India, and as a result, continue to put money into the equity markets. So that fund flow from domestic investors, to some extent, is keeping our valuations elevated. And as a result, I think to expect more portfolio foreign flows at this point would be a little optimistic.
Hi, Gautam. Good morning.
Hi.
Good to see you in. What about HDFC Bank? I think we chatted a couple of months ago, and you said that you're not expecting any big outperformance for the next 6 to around 9 months because things need to sort themselves out. But what's your view on the stock? Is it providing a good entry opportunity, valuations in favor? Banks have been really something that most investors have been looking at. Earnings haven't disappointed in that space. Your view on the big name HDFC Bank, because that's been a big underperformer actually.
No, it has been an underperformer for the past at least 2 years that I've been tracking it. We own the stock, so full disclosure there. But I think from a longer term perspective, it's definitely the bank to own among the private sector banks, and that's the reason we have it. We also own ICICI and Axis, but I think given valuations today, you're getting it at nearly 80% discount to what it's historically at in terms of price to book. So, hello? Can you hear me?
Yes, go ahead.
We lost you for a bit. You're back with us. Please go ahead.
Yeah. So I think valuation-wise, it's very attractively priced. And my view is that from a foreign portfolio investment standpoint, if you look at the total pie of the money that foreigners have pumped into India, their mark-to-market value is about 650 billion. Of that, financials are about 33%. So that's the biggest chunk of the FPI holding. And if you look at it, even this earnings season, banks have been actually performing the best results that we've seen, and they've surprised us across the board, including the PSUs. I don't mean just the privates. So my view is HDFC Bank, you will make money over the longer term, but and now would be a good point to get in.
Okay, so that's on banks. I wanted to understand, generally every Samvat, every Diwali, we talk about the big themes to watch out for, right? And we sort of get some ideas, some nuggets here and there. If you had to identify for us a couple of big themes that retail investors should look at over the next 1 to 2 years, what would they be?
Well, I think you're looking at sectors that didn't exist until about 4 to 5 years ago. And I'm a big fan of the EMS business. If you look at the top line of these companies, of course, EBITDA margins and EBITDA performance has been mixed. But if you just look at the absolute top line of these companies, they're growing anywhere from 40 to 50% year on year. So I still think that the EMS business, while it's not necessarily cheap, a lot of these stocks have had a great run over the last 12 to 18 months. But the EMS industry in India is where the IT industry was 25 years ago. And a lot of these companies are going to be multi-billion-dollar market cap companies over the next 5 to 10 years.
But profitability-wise, Gautam, you look at some of these, EMS-type companies. The big ones are based out of Taiwan, etc. Margins usually are 1.5%, under 2% broadly across the board. And these are well-established companies over the last 15, 20 years. So is that what we should expect here as well, profitability-wise? Even as growth rates, as you say, absolutely, will be strong.
Yeah, so you have even now of the 9 odd listed companies, and more are coming, I believe, in terms of to get listed. If I look at the breakup of that, and the two companies that were the poster child of the EMS industry, Dixon Technologies and Amber, they're more assemblers rather than actually doing significant value add. I mean, they're great companies, but I'm just saying their business model is more assembly oriented. As a result, their EBITDA margins range from 3 to 3.5%. But if you look at some of the other companies which are doing printed circuit boards, RFIDs, these guys are having anywhere from 9.5 to 11% EBITDA margins. So really, you need to figure out where you want to put your money incrementally in, and you got both models working beautifully within the EMS space.
Okay. Well, we've run out of time, but I want to just get a quick word from you on some of these power stocks, because we are actually heading into a discussion with Tata Power. So just before that, very quickly, is this a space that you like and something that you would recommend?
It's a space I like. It's a space I've missed out on, and I'm honestly waiting for a better entry point.
Okay, then perhaps you'd want to listen in to the conversation that we're having with the management. Gautam, happy Diwali to you. Thank you so much for joining us and have a great, great year ahead. We'll, of course, chat with you.
Wishing all of you.
Yes, thank you for your wishes. But let's get the focus on Tata Power. Strong set of numbers this quarter. The Mundra performance has aided the quarter earnings, and the Odisha operations also continue to see improvement. Praveer Sinha, the Managing Director and Chief Executive Officer at Tata Power, is with us. As always, he'll give us a sense of which way things are headed and also how the industry dynamics are looking. Mr. Sinha, good morning. Happy Diwali to you and your team, and thank you for being here with us on the channel. I wanted to start by, talking a little bit about the Mundra performance. The performance was good, but the coal contribution has come down. Given the extension of Section 11, what are the kind of profits that you are penciling in for Mundra over the next 1 to 2 years? And does it push out the long-term PPA chances?
Good morning, Sonia, and happy Diwali to you and all your colleagues in CNBC. I think the performance has been good this quarter, and this has been on back of a good performance from all our businesses, including Mundra. The Section 11, of course, has helped us because under Section 11, we get the cost, which is the actual cost of power generation. So it's a pass-through arrangement which is there, and to that extent, the restitution takes place. And whatever cost is incurred, we get a reimbursement of that. And we expect now that it has been extended up to June 24. And the demand of power being so high, it is expected that this will continue. However, we have been in discussions with the procurers, and hopefully we'll come to some sort of an arrangement much before the Section 11 gets over. And that will help us to have a long-term arrangement. Nonetheless, the Section 11 will be there for quite some time, considering that there is a huge growth in demand, and we have seen last 2 years the growth has been 10% each year. So nearly 22% growth has been seen in last 2 years. So with the type of extreme weather conditions, the type of growth, industrial growth in the country, we do expect the power demand to continue in the coming years.
So, sir, can you put some numbers to the kind of path to profitability for Mundra? I mean, what are you penciling in?
We are not looking at a profitability, but we are definitely looking at a cost reflective. So earlier we used to have huge losses in Mundra. That will not happen. So it will be cost reflective and cost neutral to that extent.
Hi, Mr. Sinha. Morning. Thanks so much for joining in. Just a quick question on this Coastal Gujarat Power Limited. What kind of ROE are you making here?
So as I mentioned to you, we are not making ROI or ROE in that. It's a cost reflective. So today there is no negative cost on operation of Mundra, which we were because of the increase in coal prices, we were not getting the full pass through as per the original PPA.
Mr. Sinha, we'll just come back to specific segments of your business in a bit, but good morning, Prashant here. The union governments recently organized a 2-day conference with states on laying out the roadmap for meeting power demand, etc. And the power minister, the union power minister, Mr. R.K. Singh, there's a PIB release. He basically said that we need 80,000 megawatt of sort of thermal power construction, which needs to happen to meet future demand. And of course, I mean, the minister said very categorically that we will not shy away from coal-based power to meet this demand, because even as they kind of sort of aspire to meet all the sort of COP targets and what we've committed to, etc. So in that context, Mr. Sinha, I mean, power is a very sort of closely aligned with government policy and with the government push, etc., thrust, etc. is. Are we looking at a big thermal cycle? We've spoken about this in the past, but since this just happened 2 or 3 days back, just wanted your thoughts.
I have not seen the details of it on what basis, but as you know, we also have a very ambitious plan in the country to have 500 gigawatt of clean energy by 2030. And that also means that 300 gigawatt of clean energy will come between now and 2030. And within Tata Power also, we have a very ambitious plan to add green capacity. We already have 5,300 megawatt of green capacity right now, and another 3,700 is under implementation. This also does not include the 2,800 megawatt of pumped hydro. So what we are trying to do is come up with good solutions, unique solutions, where we will be able to give 24/7 green energy, and a hybrid of solar, wind, and pumped hydro can be a very, very good alternate. So our plan is that we will go the route of clean energy solutions and give 24/7 clean energy, and that's the way we will implement our projects in future.
Okay, that's interesting, because I mean, if I read from the minister's comments, he says that we need about 80,000 megawatts of thermal capacity under construction. And he says all this capacity addition is being done through the public sector. Private sector investment has not started coming, but I'm quite certain that private sector investment will come. But you're saying that the preference for Tata Power will be renewable. I mean, that will be the big thrust in terms of sort of meeting power demand, the broader goals, the bigger goals.
Absolutely right. And we took this stand a few years back, and we continue to be on the script of going clean. And we will implement more and more of clean energy. We'll also implement more of pumped hydro and other hydro projects so that they can be mixed with the solar and wind and given 24/7 solutions.
Okay, all right. Mr. Sinha, I also wanted to ask you about the Odisha Discom. That's the other one that's done quite well. Could you tell us what is the outlook from here on?
So Odisha Discom, we've done a lot of improvements in terms of not only reliability of power, but also customer services. The ERP has been implemented, and many of the billing solutions which were not there earlier have been implemented, and we have now a better line of sight in terms of billing to all the consumers who were not earlier in the consumer net. We've changed nearly 25 lakh meters in last 3 years. And to that extent, the accuracy of billing and correct billing is being ensured. So we do expect that many of the initiatives that we have taken will get stabilized in the next 6 months, and the results will start coming in the next year onwards. So we do expect a huge amount of improvement that you would see in the Odisha Discoms going forward. And the results of many of the initiatives will be there for us to see.
Okay, I want to understand a little bit about the solar business also, because the solar EPC margins so far have been muted, but the order book is very strong for Tata Power. So just wanted to understand, is there a lot of raw material price fluctuation? And given the timelines of the upcoming CELU and the module plant, can you tell us, do you have scope to take the margins up further? If yes, what is the kind of band that you're looking at in the solar EPC business?
So if you remember last year, the prices of modules had gone up and many of the projects were slowed down. Now that the prices have come down, we have tied up huge quantity of modules. And you would see that between now and March, we will be implementing nearly 1.5 gigawatt of projects. And many of those projects which were delayed will get completed by March. So next 2 quarters, you will see huge amount of investment happening in the renewable business, and the results will start coming from there on.
Okay, and you have this factory coming up as well, right? So once that comes on board, then what kind of an overall growth are you looking at in the solar EPC business?
So this is a 4.3 gigawatt solar cell and module manufacturing unit, the biggest one in the country at single location, and the first one under the PLI scheme. And the objective is that the majority of our requirement for our, whether it is for utility scale or third-party EPC or rooftop, will come from this plant. And to that extent, we'll have much better visibility on the cost of the solar modules and also control on the quality of solar modules. There would be some extra quantity available with us, which of course we will be either selling it internally or also exporting. So come next March, April, we'll see a huge amount of capacity coming from this plant. And we do expect by then that the visibility and the control on cost will improve drastically.
Okay, all right. Mr. Sinha, thanks a lot for joining in. Once again, happy Diwali to you. And thanks for being with us here on the channel. Let's slip into a quick break. On the other side, we'll be joined by Pavitra Shankar, the Managing Director at Brigade Enterprises, to discuss the company's Q2 performance. Later, we'll also be joined by Viniti Saraf Mutreja, the Managing Director at Vin Organics, to discuss their Q2 earnings.
All right, well, 20 points lower is what we have. 19,422 on the index, and there is a fair bit happening. Mark, the advanced decline ratio, it's still early. I mean, only, I think 20 minutes or so, a little more than that, but it's narrowing. The gap is narrowing. So about 1150 stocks are higher and 900 stocks are lower, as you can see up on your screen. Maybe just take a look at what else has come off, more. So Renuka is down about 3%. Bajaj, actually a lot of sugar names. Bajaj Hindustan I can spot, and a few others. So this is a new addition to the losers list. But the rest are there, Midhani and Devyani, etc. We mentioned them in the morning. GE Shipping is a new one, which is down about 3% or so at about 744 at this point in time. Well, Brigade Enterprises reported a strong set of numbers for the second quarter. Pricing is up 9% sequentially, and there was good improvement in commercial sales as well. The hospital occupancy is at a 5-quarter high. Pavitra Shankar is Managing Director of the company. He's joining us right now to take some questions. Pavitra, good morning. Great to have you with us here. Thank you very much. At the outset, let me wish you, your family, your team a very happy Diwali from all of us, in case I don't get the opportunity towards the end.
Happy Diwali to you all.
Thank you. Thank you very much, Pavitra. Let's just start by talking about, just give us a real-time sense of how strong demand is as we are in the third quarter now. And give us a sense of the full year. How is it panning out to be? Will you be able to do 5,000 crores in sales for the year?
Hi, good morning. Thanks for having me. The year's looking fantastic on all fronts. Residential's been doing great, of course. The demand on ground from customers is really good. All of our new launches are doing excellently well. Under construction inventory completed across the board, the demand is really fantastic, not just in terms of sales velocity, but also pricing. So we've been able to increase pricing and there's no reduction in terms of demand from the customer on that front. So the outlook is also pretty good for the rest of the financial year. And as far as we're concerned, we are pretty bullish on the residential market for the next couple of years as well. So we are going strong in terms of launching projects, adding to the land bank, launching and moving from land bank to the launch pipeline. On the hospitality sector also, it's a really very good bright spot after some tough times. So all the hotels are doing at very good occupancies, and the average the ARRs have been improving as well. So upcoming wedding season should be pretty good for the hotels. So we are expecting hotels to do well too. On our leasing side, of course, collections, revenue, all that is going smoothly on both the office and the retail. Retail consumption has increased. And again, we're seeing the festive season. So we're expecting good things for the malls, which we're seeing in terms of footfalls as well. So only on the leasing side, we're chipping away at it since we have SEZ space. And of course, it's not looking like there's some major movement on the regulatory shift for the SEZ regulations. So, but we are still able to lease out. This quarter, we did about 0.3 million square feet in our remaining space. So I think even the leasing is going on a good front. So on all things considered, I think it's good times. We posted a good quarter supported by registrations as well. So that flew into the revenue numbers also.
All right. Hi, Pavitra. Good morning. Good to hear the commentary that you're giving us. And you're clearly sounding very, very optimistic. And as you said, bullish about the future prospects. Let's get a couple of numbers going, though. The sales number, will it do more than 5,000 crores for this year? Point number one. And realizations have moved up by around 8 to 9% on a sequential basis. More price hikes in store?
Yeah, so, the way we look at price hikes is, seeing what is possible from an inventory movement standpoint. It's, of course, important to move the inventory at a price that we think is fair, and then see if we can take up pricing and it's accepted by customers. And so far, that has been the case. And we think that it should continue on that front. In terms of sales numbers for the rest of the year, it's highly dependent on launches. We have about 6.5 million square feet of launch for the rest of the financial year itself. So a lot of our launches got pushed into the second half. So assuming all of that comes in, I think we should be in a good position, while I'm not necessarily commenting on the total value per se. But that's the hope that that's the idea. Once we get the launches, I'm not worried about what the sales will be.
Okay. But overall, you of course gave us a view on Brigade itself, but overall, how are you seeing the market, the residential market? Pricing has gone up for you, which means that, despite the kind of oversupply that we're seeing, the massive urbanization, pricing is still looking good, right? But now there is this issue that metro cities are facing, where on one hand there's rapid urbanization, on the other hand there's so much pollution. So the fear is that people will start moving out of metro cities. Do you think that could sort of restrict growth in the metros in the near future?
We'll have to see over time. Naturally, the kind of huge metropolises that we have does require a lot of planning on the authority side. In terms of urban planning, town planning authorities need to put in a lot of these measures. Despite that, we are seeing, people moving back from the tier 2 cities. The thought process during COVID and immediately after that was that we would see a lot of people moving out from the large metros. But as work from home has moved slowly to work from office or hybrid, we've seen a lot of people come back. You can see that in terms of just the rentals across, the stories are quite notorious, say in Bangalore or wherever, in terms of rental price hikes or just trying to find an apartment. So I think that naturally tends to increase the demand for people looking out for their own homes. And so far, interest rates have also stayed stable for the last 6 months or so. The repo rate hasn't been increased, so therefore interest has also been, the mortgage rates are the same. So I think right now customers are just looking for the right quality, the right developer to go with. And when a launch comes out from someone like us, they're basically ready to book and make sure that they get the right unit that they want, because they're thinking about end user and occupancy. So therefore pricing is more of a second situation.
No, I take your point, but my only limited point here is you'll have the right quality in terms of the builder, but what if you don't have infrastructure? There's so much pollution, you just want to rethink your decision of spending that top dollar on premium housing, and you'd rather sort of move to a place where there's lesser pollution. Okay, that's a discussion for another day, but let me get back to the business, right? Leasing has improved this time. Of course, this was after weakness that you saw in Q1. So can you tell me, what is the annual exit rentals that you're looking at?
So as of half year, we've done around a little under 400 crores. So that should stay on track, because a lot of that will just grow at a stable rate. Some of the new leasing will just need to burn off the rent-free periods, and the lease rental will have to come in. But stabilized on an exit rental, we are looking at maybe 750 crores as a total rental portfolio today. That's with the operating assets. Sorry, that's with the operating assets that we have as of now. We also are constructing some. We are constructing some new office buildings. So once those also get rented and leased up, those will add about 180 to 200 crores on the top line.
Pavitra, very quickly before we let you go, there was a change in the Karnataka government. Have state approvals started coming through smoothly, or is that still a bit of an issue?
It's been a bit of a mix. Some things have happened smoothly. We are seeing a slowdown or just sort of a holding period in terms of some of the approvals coming through. But there are discussions, constantly on trying to push a lot of that. I think there are meetings that need to happen, for the authorities themselves. So yeah, we are seeing a bit of slowness on the approval side. Things had picked up after the government had just come in. It stabilized a bit, but now somehow we're seeing a few more delays. So hoping that it won't impact the rest of the launches that we have planned for the rest of the financial year.
Okay, all right. Thanks a lot for joining in, Pavitra, and all the best for the quarter to come. Thanks a lot for being with us. Let's focus on Vin Organics now. It was a weak set of numbers for them. The company witnessed sequential recovery but continued to see pressure on a year-on-year basis. Vinti Saraf Mutreja, the Managing Director at Vin Organics, joins us now to talk more about her business and the way forward. Vinti, thanks a lot for joining in. Happy Diwali to you and your entire team. Good to see you in your festive gear and hoping this is a great year for your business. Year on year, though, there is some pressure that you've seen. The revenues are down 20%, EBITDA is down about 25%. Has there been any sequential recovery in demand, and what is the pressure? Where are the pressure pockets that you're still facing year on year?
Sure. Happy Diwali, Sonia. See, year on year, actually, our revenues, in my estimate, this year we will not be down as much. I know in H1 we are down combined maybe 15% or so in revenues, but our merger with from NCLT for butyl additives just got approved, but we're still waiting for the approval in writing. So once we're expecting that to go through in the next month or so. So from October onwards, the revenues of butyl additives will get added to our financials, which wasn't the case in H1. Margins actually have remained intact at 27% of revenues, but the volumes have come down. Last year was a great year. Actually, we saw some excessive buying in a lot of our products, and hence by March, April, our customers were sitting on a lot of inventory, and this destocking has been going on, which will continue to do so in December itself. And that's why you see the overall bottom line being down by about 15-20%.
All right. Hi, Vinati. Good morning. Thanks so much for joining in. Well, how much will viral additives contribute for this year?
See, this year, it'll be just for 6 months, and it's doing about 30%, 40% of capacity. So maybe around 100 crores or so in this financial years.
Got it. And in fact, do you get the full impact in FY25? So what does it ramp up to?
Right. Well, hopefully we attain better capacity utilizations, close to 50%, at least 60%. So maybe around 400 would be my
400
target.
Crores.
Yeah.
Lovely. All right. So we got that out of the way then. Now, your ATBS segment out there saw the highest amount of destocking. Is that coming to an end?
Well, December is the year ending for most of our customers. So we expect that, they would be sitting on zero inventory by December. And so they would start buying again from December, January for us, because the demand remains steady across sectors for ATBS. Hence, we are continuing with our expansion as well, which is on track to be completed middle of next year.
All right, got it. Overall, for FY24, what are you guiding in terms of revenues? I think the first half you've done about 900 crores. What kind of growth can you do in the second half?
Yeah, maybe a 10% growth from there, given butyl additives and some ATBs, maybe 15%. I think we'll be just a little below 2,000 end of this year is my estimate.
Okay, below 2,000 crores on the top line end of the year. And what about in terms of the margins? I think your exit margins in the first half is about 25%. So what are you looking at in the second half?
So similar. I think the margins, mine are showing 27%, but yeah, similar EBITDA margins.
All right. Vinati, what about antioxidants, AO? That started contributing to revenues, I think, in this year.
That's the butyl additives that we spoke about. That's the butyl additives.
That's the one. Got it. Also, you were talking about some expansion in the ATBS segment, I think so. So what's the outlook out there with regard to the expansion?
So the expansion's on track. Our 10-year outlook on ATBS still remains the same. We think it's a product that has multiple uses and continues to grow over a longer term. And so that's expected to complete by June of next year.
By June of next year. Okay, all right. So it's pushed back a little bit.
Slightly, yes, slightly.
Okay, all right. All the best, Vinity. Thanks for stopping by and giving us a quick take on the business and the way forward. That's Vin Organics. Let's slip into a quick break. On the other side, we'll focus on the commodity markets. Manisha Gupta will be joining in. Stay tuned. Welcome back. Well, for now, the markets, as you just saw on your screen, are very, very quiet. Not too much happening. But there are plenty of stocks in the broader market. So the Midcap index is up almost about 115 odd points. And lots of stocks. United Spirits was one stock that's, trying to climb up on the back of a good set of numbers that the company has reported. But apart from that as well, Brigade Enterprises, by the way, after the management commentary, just look at that stock, 6.5% higher now on Brigade Enterprises, looking very good. The entire real estate space is looking good. So Brigade, Soba is also up about 5%. And then you have the tire space that's looking very good. So you have Seat, Apollo Tyres that are all in the green. We had cracker numbers coming from Apollo Tyres. So in 2 days, the stock is up almost about 10 odd %. Mitesh Thakkar is with us. So let's go across to him to find out more. Mitesh, first on these tire stocks, is there still more upside beyond the kind of gains that we've already seen?
So I think there's a good chance of further upsides happening. See, I think, I was looking at the charts of Apollo Tyres, Balakrishna and MRF. Now, MRF has been, sideways in the last 2 to 3 months, broadly doing a range of 10,600, 700 to about 11,200. There is a chance that we'll see a breakout above these levels soon. And once that happens, I think, it can head towards 1,20,000 odd kind of level. So very positive on that. Apollo Tyres, which after correction has started an up move in the last 3 days, is now close to the resistance levels of 430, and then there's the all-time high of 435, 437. So I think around these levels, you might see the stock take a breather, but eventually I think it'll cross and break into all-time highs. And similarly, Balakrishna Industries is at the all-time highs. I think it's never had a closing about 2,610. And I think today we are seeing the stock trade above that. But the structure is also positive, so I think that could also, suggest a breakout and head towards 2,700, 2,750 zones. So quite positive on the towers, on the tire stocks.
All right. Mitesh, I want to ask you about a couple of other names. Mahindra and Mahindra, that one has moved up. It's up close to 2.5% as we speak, and it's, been trending for the last 45 minutes or so. Your view on the stock, where does it hit resistance?
Now, it's one of my recommendations. I think, on the intraday charts, what we are seeing over here is that the stock has kind of reversed after giving a good correction. And now I would recommend buying this with a stop below 1492 for targets of around 1585, 1590 on the upside. So that's one. And the other one is Dixon Technologies. I think that's also after a pullback is trying to get on the upside. So that's a buy as well. Keep a stop at about levels of 53.45 and a target of 5,500 is what I would recommend.
Okay, all right. Mitesh, have you looked at Genius Power, on the charts? I'll tell you what, that stock in this year is up 200%. It went to around 300 rupees and Genius Power actually has corrected from there. And, every time it goes to this vicinity, it's seeing some selling. Have you looked at it on the charts? It's at around 250 rupees now?
Not much, honestly. I think I've not been tracking the stock regularly, unfortunately.
Got it. Okay, all right. Mitesh, so we'll let you go at that. We'll, reconnect during the course of the day and get the other picks as well from you. By the way, just take a look at PFC and REC. Both of them, they're blazing away. They've moved to the high point of the day. So those stocks, in fact, they continue to do well. They've re-rated this year itself. And on the flip side, Godrej Consumer, the stock has slipped in the last few minutes. So let's pull up the intraday chart out there. You have the stock that opened up in the green, but now Godrej Consumer has moved into the red. For the time being, though, we'll slip into a short break. When you come back, we'll turn our attention to the commodity space. Manisha Gupta will be joining in. Welcome back. Well, we're trading for the last 45 minutes or so, and I'll tell you what, the Nifty is not moved. The Nifty is as flat as can be as we speak, just a point movement on the downside. So that's been that sort of a market. But in the broader markets, plenty of stocks are moving around. But we've been telling you about the equity markets for a while. So let's turn our attention to the commodity markets. Manisha Gupta joins us as always to tell us what's going on there. Manisha, over to you.
Thank you so much for that. You know, it's a good time for consumers. You have crude prices down, gold is corrected quite sharply on the lower side. And the other thing that you buy during festivities is clothes. And the cotton prices as well are trading at a 12-month lows in the international markets. As per the International Cotton Advisory Committee 2023-24, when you look at the global production numbers, well, that is expected to increase by nearly 3%. And the markets are looking at higher production in the global markets right now. The not so good news really comes in from the consumption numbers, where we have seen nearly 0.5% of a decline. So these are the exact numbers really for the next season. 25.4 million tons of production. Consumption expected slightly lower. And the warehouse stocks is expected quite comfortable at 14.5 million tons there. So when it comes to cotton in the global markets, whether it's about textiles and various other industries associated with it, we are looking at production higher, consumption not so much, and the margins really getting impacted. Large crops internationally for cotton are expected in countries like Brazil, Argentina and Tanzania. Not so great crops coming in from US, Australia and Greece as well. For the Indian markets as well, we have seen a bit of a hit come in for the crop this time around, and not so much for a crop but the yields as well. So the production is expected down 6% on a year-on-year basis when you look at the Indian cotton crop this time around. So when you look at the production itself, we are looking at around 31.65 million tons, which is the lowest in last 15 years when you look at those numbers. If you look at the last year as well, the crop was higher at 31.89 million tons, and 15 years ago is what we are comparing ourselves to in 2023-24. At that time, the crop was at 29 million bales. So that's as low as what we've gone in sense of crop productions there. When you look at the Indian cotton demand as well, that is estimated at 31.1 million bales, which is lower in what we saw in the previous year as well. So even as there is crop coming into the markets, the arrival are slightly slow, one, and two, the demand is not so strong at this point in time. The Chinese demand also continues to be on the weaker side, and that has had an impact on the prices. So in last 1 week, we've seen the prices decline by 6%, and the global cotton prices have fallen by 12% in last 1 month itself.
Okay, all right. Thanks a lot for that, Manisha. But let's focus on some big movers in the first hour itself. Upasana joins us to tell us about MTAR Tech. The stock is under big pressure. Upasana?
MTAR Tech has reported its Q2 FY24 numbers, and the company has also revised its annual guidance for FY24. In terms of the annual revenue guidance, the company has cut it by almost 25% to 670 to 700 crores. In terms of EBITDA margins also, the company has cut its margin guidance for FY24 from 28% to 26%. Now moving towards the company's financial performance in Q2 FY24, the revenue saw an uptick of almost 32% on Y-on-Y basis. The other income was down by almost 85%, impacting the PAT growth. And the total expenses also hiked up by almost 44%. That's why the margins were impacted. Coming to EBITDA margins, it stood at 21.7% versus 27.7% for the quarter. Now, in terms of order book, the order book of the company stood at 997 crores, and company has locked almost 80 crores of new order in Q2 FY24. So all in all, we are seeing a weak set of numbers coming in from MTAR Tech, and also the guidance cut is something which we should be noting.
Well, that's clearly weighing on the stock. Thanks a lot for that, Upasana. Well, focusing on Welspun Corp, those numbers look quite good out there. On the top line, there was a big growth. In fact, there was a doubling of revenues. A couple of factors played out. There already won big orders. Execution is picking up, particularly in the US business as well. And in addition to that, you had the others in the plastics business that contribute roughly around 150 crores on a quarter-to-quarter basis. So that's one factor that resulted in this big surge on the top line. Volumes as well have picked up. Now, on the EBITDA front, it comes in at around 400 crores odd, but there's a one-time impact of close to around 50 crores. That's due to the cyclone, and that's inflated the other expenditure. Otherwise, the EBITDA number would look far better. Margins on a sequential basis as well have improved from around 9.1% closer to around 10%, and that includes the one-time impact in there. The net profit as well looked quite good, and the other numbers that they've given is quite good. The total order book size is close to around 8,000 crores, so that's something that's good as well. And the net debt number has been gradually reducing, and that's come down by another 500 crores. So that's why, in fact, those numbers go down as a beat. Well, for the time being, though, we'll slip into a short break. But on the other side, you don't want to miss this conversation. Lata will be catching up with Amitabh Chaudhary, the Managing Director and Chief Executive Officer at Axis Bank, to discuss the past quarter's numbers and, more importantly, the way ahead.
Welcome back. It's a Diwali special guest, Amitabh Chaudhary, we are waiting for. But while we get Amitabh on the line, let's apprise you of Nazara Technologies as well. The stock has slightly done better after the challenging times it saw. Rima is here with the key takeaways from the results. Rima.
Thanks so much for that. So this is a gaming company. It is esports. It even has Gamify Learning, the Kidopia app for children under the age of 5. And plus, it's now dabbled into gambling, the real money gambling, which got impacted by the 28% GST on entry fees. So here are the numbers for Q2. The top line growth has come in at 17% quarter on quarter. Year on year, it's a growth of about 13%. EBITDA margins are higher on a year on year basis, but sequentially, there is a decline in the margin. And that's because the company has spent more on acquiring content or event costs. They also do a lot of live events. Profits for the company have actually doubled on a year-on-year basis. Now, if you break up the top line growth, right, of about 13%, esports has done well for the company, gamified learning for the company has done well, but the ad tech revenue, now that has come under pressure because the company has said that they are trying to get away from the low margin business. They're also trying to expand their client base so that they're less dependent on, a select few clients. So because of that, you've seen a sharp 35% decline in the company's ad tech revenues, where they help companies monetize, on a gaming platform, you will see ads, right? But which ads should be there? How do you make the most of it? That's done by this company, AdTech. Now, on the, touchy topic about the GST revenue, which impacted their real money gaming business. Remember, it's not a huge impact because it's less than 5% of their overall business. But here's what the company had to say. Okay, Classic Rummy, which is the real money gaming, is likely to report a loss in Q3. Back to you.
Okay, I'm sorry I'm hurrying you. Our guest is with us. Thank you very much, Reema. Well, so like I told you in today's Diwali special, we have a banker who posted a cracker set of Q2 numbers. We have Amitabh Chaudhary, Managing Director and CEO of Axis Bank. Well, I said it was a pataka result because I think Axis was the only bank, large bank, to have posted a higher margin than in the previous quarter. Every other large bank, and the comparison will run for you, did show a fall in margin, some of them even to the extent of 25 basis points. Also, the fall in gross NPAs for Axis was much more than for comparable banks. So, without much ado, welcome Amitabh, and many congratulations for a great set of numbers. Okay, let me start with the bread and butter questions first. Credit offtake, excellent loan growth at 23%, both overall as well as retail. Now, you've seen the festive season demand, you've seen the Diwali demand. Do you think Q3 will do better?
Firstly, Lata, wishing you and your team members a very, very happy Diwali. Thanks a lot for coming here. Yes, well, there are strong signs that the economy grew stronger than 7% in real terms in the September quarter, and the momentum has continued thereafter. We are seeing, if you look at some specific sectors, cement, construction demand, power demand, I mean, there are very clear signs that some of these things are picking up. Profit growth for the corporates in the second quarter has been strong. And this is happening despite the economy facing fiscal and monetary headwinds. So from my perspective, while RBI is keeping liquidity tight, likely due to global uncertainty and global shortages, my view is that the credit offtake will continue at the similar pace as what we have seen in the past. Some banks are growing at a faster pace. But at the same time, and in the same breath, I have to mention that the deposit growth continues to lag. It has been tough. Most of the deposit growth is coming in the form of term deposits rather than CASA. You saw CASA drop for most of the banks in the second quarter. And if this gap continues, at some stage, this gap does need to be bridged. So we cannot have a situation where credit growth just keeps, being ahead of the deposit growth for a long period of time. At some stage, they do need to converge. And my only worry is that if they don't converge, then we'll be forced to converge again. Otherwise, the economy seems to be doing all the right things. And from that perspective, the prospects look bright.
Okay, well, actually, then let me upgrade the deposit question that was anyway going to come. You did about 17.5%, 18% in terms of deposit growth. Now, obviously, last quarter, there was this one big bank which was aggressively picking up deposits, and you also had the ICRR imposition. So deposits went through a challenging quarter. Now, will you go aggressively after deposits? I mean, and if that happens, what is the target, internal target, and what does it do to margins?
Well, Lata, we are trying to balance a number of things at the same time. One is that obviously deposit is the starting base for everything. So we have to get the deposit growth right. At the same time, we want to ensure that we do it profitably. You want to ensure that the NIMs are maintained. Third, if you go aggressively after deposits, you are in a way spoiling the entire, your liability franchise by making them fall into a habit of waiting for that extra aggression to go and get and source deposits. That's not the right way to build a long-term franchise. And actually, Axis has been trying very hard to move to a state where, on a quarter-on-quarter basis, we sustain what we do rather than do these one-off things which then come to hurt us later on. So from our perspective, it's a bit of a balance. Balance on one side where CASA is difficult. Term deposits, especially the retail, yes, are growing at a faster pace, but we need to ensure that they don't come at too high a price. We don't want to rely too much on borrowings and wholesale deposits. And at the same time, we would also like to maintain NIMs. At the same time, we would like to capitalize on the growth, the credit growth which is available in the marketplace. It's a fine balance. We obviously are watching the numbers on a daily basis. We have some medium-term plans in mind. We have some obviously short-term. We have to react to what is happening in the market. So I'm giving you a long answer. And if I was to give a one-line answer, it's not a simple answer. It's a complex answer. And the answers does differ a little bit depending on how the market plays out. So from that perspective, we are just trying to find the right balance. And I think our numbers in the last quarter reflect that. We have obviously our deposits priced much faster than some of the others. And we were able to do a number of things on our cost of fund side and on the yield side, which allowed us to bring the margins up a little bit. It is a constant, battle in that sense. And at the same time, we were able to deliver a good credit growth. But
okay, let me tie you to a number there. Yeah, sorry. Exactly. That was going to be my question. Balancing so much is not easy for a very long time. So do you think you will be, how much will the margin crunch be in the current quarter or for FY24? Will you have to give away 10, 20, 30 basis points?
Well, we believe that the marginal cost of funds has broadly stabilized. We expect deposits cost, however, to increase further over the remaining part of the financial year. But the pace of deposit cost growth, we believe, will most likely moderate. See, from a guidance perspective, that's why we have been quite careful. We have said that our margin guidance is 3.8%. We have built a cushion of 30 basis points over that. Okay. And our endeavor would be to retain as much of that cushion as possible, led by multiple structural drivers we're working on, both on the yield side and the deposit side. So I don't want to give a guidance, but I only want to say that our real effort all this while has been to ensure that we keep this cushion as much as possible, though there are various variables which are moving and moving quite rapidly.
Okay. All right. Now, let me come back to the loan growth story, because there I want to get some more detailed answers from you. While retail credit also grew by 23%, your personal loans and credit card have grown by 39%. Now, the RBI itself has, put that on the table in the monetary policy statement, saying they are worried about personal loans and these would be unsecured loans. Yes. So are you consciously bringing it down?
So on the credit card side, the significant growth you're seeing is because of the base effect. We did not have Citi in the last year numbers, and we have Citi credit card numbers in this year. So credit card growth is good, but it's not as large as it seems because, the year-to-year comparison has Citi missing in one of them. Yes, the personal loan growth was quite reasonable and we're quite happy with it. It is one of the key drivers of credit growth. While the normal PL has grown by 2x in the last 2 years, that the small PL has grown by 4 times in the last 2 years. If you look at, Axis Bank, 85% of our growth is coming from existing to the bank customers. We have not seen any. The way we are growing and the reason we are growing is not because we are changing our risk guardrails. The reason we are growing is we are stacking our customer segments differently. We are attacking some of the distribution channels where our presence has been limited. We are asking and improving the customer journeys and the distributor journeys. So it is all about making your business more seamless to the customers and to the distributors rather than doing anything and changing anything on the risk side. So we are not taking additional risk. Yes, because others seem to be taking additional risks, we have to be watchful of what we are doing. So we are watching our portfolio very, very closely for any signs of stress. We are not seeing that, but we're fully cognizant of what the governor and RBI has been indicating for the last couple of quarters, that they're worried about the rapid growth in personal loans and some of the stress they're seeing in the system. And we are also watching it closely and obviously sharing some of that data with RBI. Right now, as I said,
if you can share something. No, I get it. If you can share something with us, I'll tell you why. Because Cholamandalam, when they did their conference call, they specifically said that their new segment loans have shown a higher NPA of 4%. And loans that originated from fintechs have, over a 12-month period, shown a low NPA of 10% plus. So, I mean, do you all have fintech originating loans in your bank? Have you done that kind of granular detail to be sure that you won't have an unsecured loan shock?
So, Lata, we monitor our loan portfolio across partners, across customer segments, across geographies, across loan sizes. All the cuts are done, right? And as I said, we have not seen any major concerns yet. We have, amongst the larger banks, we have the largest number of, fintech partnerships. And we have 2 large fintech partnerships where we are doing PLs. We are not seeing any signs yet. But then, let me immediately add a disclaimer clause there. We have been very clear that we will do the underwriting. And we are applying the same underwriting standard. Does not matter it is a DSA or a fintech or it is our loans which are being originated by our own sales force. So in that sense, yes, sometimes the data which is available is different. Sometimes you need to use a different data set to reach the same conclusion. But we are not changing our underwriting standards at all because it's a fintech. It's just a source of a customer for us. So in that sense, we are not seeing a difference. That does not mean that the difference will not emerge. But my worry is, and I don't know with the specific data about Chola, but obviously I know about this 10% data point which you mentioned, that maybe in some of the fintechs which they have a partnership with, maybe, I don't know, that the underwriting or the way the underwriting is being done or the way the growth is happening maybe is happened at a pace where some of these loans have gone bad. Maybe the size of the loans is quite small. And I'm sure knowing Chola, they'll be taking corrective actions around it. We have not seen anything as yet.
That is very reassuring that, you're also privy to all this data and you are already doing that kind of granular underwriting. Now, just one more piece of worry. Maybe I'm connecting the two unconnected things, but we have seen a growth in equity derivative volumes. There was that excellent report from your mutual fund. Now, separately, there are these personal loans growing. Is there any doubt in your mind that personal loans are being used to, take punts in the equity derivative market? If that is, are you looking at, when you give a loan, where it is being spent? Is it going to depositories? Is some such trailing being done?
Well, if you look at the growth in volumes on the derivatives side, it is alarming. And we also know that data very clearly shows to us that it's been publicized quite well that 95% of the people lose money. And we are also seeing signs that some of the employees generally broadly in the banking system are resorting to wrong practices because they have drawn up debt at a very, very rapid pace. And in some of those cases, it is around betting or let's say taking positions on derivatives or whatever they might be doing. Because, why have all these betting companies and why some of the, derivatives have prospered so much? Someone is obviously taking some risk. And if everyone is losing money, they're paying for it. And that's why the kind of customers you're lending to and the profiling of the customers you do is very, very important. As we said, 85% of our lending is to existing to the bank customers. We do obviously monitor the transactions that are happening in those accounts. We also look at the profile of the customers. We also look at their, what is the leverage they have, how many loans they're taking, what they're doing about it. So it's a constant process. It's not that they give a loan and then forget about it. And yes, we are monitoring it. It is a worrisome sign. That's why our mutual fund came out with it, that, this is something which is happening, which should be looked at. Because, end of the day, if I run up debts, something will happen. Something has to give. And it will impact the system broadly at some stage. Maybe that's why some of the statements and the commentaries coming from RBI also. So let me just say that we are watching it very carefully. Yes.
Okay. Well, just a final question on credit cost. Even that's fallen admirably for you, more than it has fallen for other banks. Is this the best you will do, or is there scope to do even better?
So, Lata, we have been tightening our underwriting and credit standards over the last 5 years. And obviously, what you're seeing today is a result of all the belt tightening that has happened. In my view, we have been saying again for the last couple of quarters that this is some of the historical lows you have seen for the banking system. It would move towards a more normal kind of credit cost. We have talked about 60 to 80 basis points, which is lower than our long-term average. We don't know where it will finally end up, but some of the costs which you're seeing right now are at historical lows. And as a bank, we are in the risk-taking business. So for us to hope that this will continue, I think it will be a bit unfair because we are also growing on the credit side at a reasonable pace. So I would say 60 to 80 basis points is more the number we should be looking at rather than where we are today over a period of time. Let's say how much time it gets there. It takes to get there.
Okay. Well, anyway, it's a cracker set of numbers. Many congratulations. And here's wishing you and everyone at Access and your team a very happy Diwali.
Thank you so much, Lata. Always a pleasure.
Okay. Well, that's the word from the big man from Axis. They are keeping their eyes really wide open for any signs, but very ambitious on growth and on asset quality. Wrap up on Bazaar on that note. Chartbusters up next.